I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the new dawn of digital ads, presidential campaigns innovating in new ways to reach people across every platform. The problem is every platform has different standards. Blame the message or the messenger. Plus, employee endurance in an age where technology makes working from home possible, how the coronavirus is impacting the workplace. And global domination. Tesla is one step closer to opening a massive factory in Europe. The car maker winning court approval to clear a forest for its next facility, where it eventually plans to make 500,000 cars a year. We begin, though, with a flight to safety in the markets as U.S. stocks sank Friday amid renewed concerns over the coronavirus. Tech companies particularly hit hard. With more, I want to get to our Taylor Riggs in the newsroom. Taylor, what happened?
Yeah, Emily, certainly a risk-off day for the markets here. The S&P 500 was off about 1%. And if you show the board, we can see that tech really bearing the brunt of the losses, off almost 2%. And you can thank the FANGs, frankly, for most of the losses. Companies like Apple, Amazon, Alibaba off anywhere from 2 to 3%. AMD, I wanted to show that chart because they get about a quarter of their revenue from China. So investors certainly pulling their chips off the table as they headed into the weekend, given some of the nervousness that we're seeing about the coronavirus. Flip of the board, I want to take a look at where we are in terms of sectors here. In the last 5 days, you can see that tech, clearly the worst performer, off about 2% or double what the S&P 500 lost this week. Infotech sector, again, losses led by AMD, NVIDIA. They get a quarter of their revenue from China. Finally, come and take a look at a chart here that I'm showing inside my terminal, because I really wanted to put the losses, Emily, into perspective. We talk about how the stocks and the chip makers are off 3% today. For the week, they're off about 3.3%. But as you can see, it's hardly one of the worst weeks they've had. So really wanted to put these losses into perspective. A bad week, but we have had worse. Investors clearly didn't want to go into the weekend with a lot of risk assets in the portfolios. Emily.
All right, we will see what next week holds. Taylor, thank you. Well, while his Democratic rivals are fighting to secure endorsements and delegates, President Trump has nailed a coveted election prize, advertising on YouTube's homepage. Bloomberg has learned that Trump's campaign ads will take over the YouTube masthead on Election Day and in the immediate run-up. Think of it as the digital equivalent of a Super Bowl TV ad that'll hit a wide swath of people at exactly the right time. Joining us from Washington to discuss, Michael Beckel, research director of One Issue One, a nonpartisan group advocating for more transparency in campaign spending. And with me here in the studio, Krishna Subramanian, co-founder of Captivate, a firm that connects social media influencers to corporations. So, Michael, I want to start with you. How big a deal is getting the YouTube masthead on Election Day, given that there are other opportunities, other ad outlets out there, but this is a big one?
This is absolutely a significant development. This is the Trump campaign taking advantage of their resources to put money down early to secure very valuable real estate online. And it also demonstrates a way that campaigns are trying more and more to reach people online. Broadcast TV and radio aren't reaching as many people as in elections past, so they are turning over every rock on the internet to be able to go to where the people are. And a lot of people are going to be on YouTube in the days up to Election Day.
Now, to give you an idea just how competitive this is, President Obama actually bought the YouTube masthead back in 2012 before Mitt Romney even became the Republican nominee. Krish, you know, the Democrats are still battling out just for the nomination. Apparently nobody is thinking that far ahead, even though they've been somewhat innovative themselves. Yeah. You know, what does this mean?
I think you characterized it as the Super Bowl for digital advertising is the perfect way to think about it. Because getting 60 million people or so on YouTube all at once, tuning in at once, is that opportunity. It's so much harder to do that across Facebook and Twitter and all these other social channels all at once.
So, Michael, let's talk about the other avenues here. Obviously, we've seen the rise of SponCon, or sponsored content, where you have presidential candidates actually paying influencers to post about them. Michael Bloomberg, the founder of this company, the parent company of Bloomberg News, being one of them. You know, there are other ways to reach people, and candidates seem to be learning and trying new things every day. How does YouTube stand out against all of these other opportunities?
Well, that's absolutely right. Candidates are trying to innovate online because that's where so many people are spending so many hours of their day. This election, we're seeing ads on YouTube, we're seeing ads on Facebook, we're seeing ads on Google. We're also seeing ads within streaming services like Hulu, or people opening up their phones to play games and getting political ads within apps. Candidates are leaving no stone unturned, and really it comes down to how much money candidates have to be able to experiment and try to do something. This YouTube masthead ad could have been purchased by any candidate or any political group, but here President Trump is making a power play, reserving it early, while the Democrats are still fighting about who the nominee on their side of the aisle will be. No other political group came in this early to try to swoop that ad space up, so his campaign has.
And to that point, I actually sat down with Brad Parscale, Trump's campaign manager, back in 2018, and he was talking even back then about the power of YouTube, which was sort of ironic given that there was this controversy around Facebook potentially helping Donald Trump win the election. Take a listen to what Parscale told me in 2018.
If you're watching Facebook for 4 hours this year, but next year you're watching 3 hours of Facebook, but 1 hour of YouTube, that changes. So we're going to monitor where eyes are going. I think YouTube continues and Google continues to work on that platform and make improvements. I think what Google has done to the search algorithm also to put YouTube results at the top, they continue to put a lot of focus and they understand the value of that platform. So we're watching it closely. We're using it for a lot of things now. We're using it probably more now than we even were in 2016.
Krish, if the Democratic candidates had just paid attention to that interview, they wouldn't be in this position. Let's talk about the rise of sponsored content, the other ad innovations that we're seeing that are controversial and also giving some of these big tech companies big headaches because they don't know how to police it. What's next? Mm-hmm.
I think what you saw with the recent Instagram sponsored content that was coming out is very interesting because you're getting in-feed memes and messages by sponsored memes. And that's the first time this has ever happened. This is the first time a presidential candidate has actually gone to influencers to really leverage their audiences to target that younger demographic.
You wonder why it's the first time. It seems almost obvious. Why didn't anyone else think of this?
Yeah, I think, let's say 4 years ago or so, I feel like the candidates were experimenting around with it. But today, you're looking at people spending $1 million a day on Facebook in advertising. And that's like what some of the top advertisers are doing on their own. So they're seeing true value. Look,
Michael, you are campaigning for campaign finance reform. How do you think this kind of advertising, if you will, should be policed?
Well, at the end of the day, we want to make sure there's transparency when it comes to who's sponsoring ads on the internet. Right now, if you run an ad on television or radio, there's a certain amount of information that you as a viewer can see about who sponsored that group. And those context clues are important to help people assess the messenger as well as the message that they're seeing in ads. Right now, the internet is the Wild West, and the rules for political ads online are vastly different than the rules for broadcast television, for radio. Each company right now, whether it's Facebook or Google or Twitter, they're each setting their own rules about what they want to share with the public about who's running ads, who those ads are targeting, how much those ads cost, and whether you as a general member of the public can even see those ads, or whether only the people who are micro-targeted by those ads are seeing those ads. So this is a place where Congress could step in and set uniform standards so everyone plays by the same rules and the public can assess the ads.
I just want to jump in there quickly because YouTube actually, according to our reporting, considered not having any advertising on the masthead on Election Day and actually instead putting up a banner encouraging people to go out and vote. Should they have done that instead?
Look, the political ads on the online spaces are here to stay. We're very much in favor of making sure that people are getting informed about voting, making sure candidates are going out and sharing information in a way that there is transparency and accountability. Right now, there is no uniform standards for each of these platforms when it comes to disclosing who's sponsoring the ads, and that is where we see the most room for Congress or the Federal Election Commission here in Washington, D.C. to step in.
All right.
So,
well, a story that for sure is going to continue to evolve as the race for the Democratic nomination gets more bloody in the general after that. Michael Beckel of Issue One and Krishna Subramanian of Captivate, thank you both for joining us. Coming up, the coronavirus continues to impact the global economy, impacting workers and workplaces alike, where the fallout continues. That is next. This is Bloomberg. Altria Group shares dip Friday after a report in the Wall Street Journal said the SEC has opened an investigation into the tobacco giant's $12.8 billion investment into e-cigarette maker Juul. The Journal saying the SEC is probing whether Altria adequately disclosed the risks of the investment. Altria's investment in Juul in late 2018 valued the startup at about $38 billion, but its position has since been written down to $4.2 billion amid new restriction on Juul's business. Joining us now from New York to discuss, Bloomberg's Angelica LaVito. Angelica, what do we know?
So we know, according to the Wall Street Journal, that the SEC is investigating whether Altria adequately disclosed the risks of the investment to its investors. Obviously, we know that the investment has been quite a headache for Altria. The stock is down. The deal still has not even been cleared by the FTC. And we know that that Juul's litigation risk is affecting Altria. Altria has said that litigation against Juul has increased about 80% since October 31st. So this is just the latest headache for Altria.
What does this mean for Juul?
Well, for Juul, again, it's just another headache. They've obviously been under an immense amount of pressure. And so for this, it's just another possible problem for them.
So how do these SEC probes ultimately play out in generally? What do we expect is happening right now behind the scenes?
That's a good question, and the Wall Street Journal reported that the SEC has sent Altria and Juul subpoenas, and that both companies have responded to the subpoenas. Exactly how it plays out, we'll have to see.
All right, well, we're going to continue to cover that story. Again, the SEC opening a probe into Altria's big investment in Juul, which made a lot of waves at the time. Bloomberg's Angelica LaVito, thank you so much for joining us. Well, the number of Americans infected by the coronavirus has risen to 34. This according to the Centers for Disease Control, which says that number is actually likely to rise. Most of those infected are among hundreds of Americans who were evacuated by the U.S. State Department from Wuhan, China, the epicenter of the outbreak, and a cruise ship docked in Japan. They're quarantined at 4 military bases across the United States. Meantime, the virus has already affected the supply chains of major companies, including Apple, and forced the cancellation of global events like Mobile World Congress in Spain. Joining us to discuss the impact this is having on companies and their workplaces, Brendan Horgan, attorney at Eckert Siemens. So, Brendan, what's interesting here is technology has perhaps dampened the impact this virus might have had 10, 20 years ago, enabling people to work from home. Some of our colleagues have been able to continue to work from home in Asia despite this crisis. What impact are you seeing on work and the workplace?
Well, thank you very much for having me. First and foremost, this is something that businesses and employers are really focused on right now, and they're talking a lot about what needs to be done stateside to keep their workplaces safe from a prevention perspective, and also from an employment policy perspective. What types of policies, like you discussed, may need to change given the unique nature of this situation. We're seeing a lot of employers who are readdressing their policies regarding teleworking, regarding leave, regarding sick days, regarding things like that. And you're right, technological advances have afforded a lot of different types of businesses the ability to do that. And a lot of the guidance coming from the CDC speaks to separating employees who are exhibiting any signs whatsoever of respiratory issues, advising those employees who exhibit those symptoms to stay home. So employers are having to navigate those best practices and try to balance them with their employment policies, and sometimes you have to flex the policy.
There's sort of that code red moment where the outbreak is exploding, everybody, sends people home from work. Now we're a few weeks into that, and nobody knows if it's going to get worse before it gets better. How are workplaces dealing with that kind of uncertainty?
It's hard, and there's not easy, bright line answers from a legal perspective or from any perspective. The thing that we counsel employers to do at the outset is to communicate with your workforce, number one, and number two, have an actual plan in place. And companies should get the stakeholders together, whether it be worksite safety managers, human resource personnel, upper level management. They need to review the OSHA guidelines on the OSHA website. They need to review the CDC guidelines, and they need to formulate a plan for how they're going to keep their workplace safe, how they're going to train their employees, and how they're going to deal with the hysteria and the fear, which is really understandable. I mean, it's a scary thing. It's so widely reported that it's something that a lot of employees are expressing concern about. So the key for employers is to communicate with your workforce, listen to them. I mean, if your workforce is expressing concerns, if they're expressing fears, listening and addressing and adapting to what your employees have to say. So the bottom line is communicate and let the employees know that you as the employer are doing things to keep them safe.
All right, well, thank you for communicating that with us. Brendan Horgan of Eckert Siemens, thank you so much for joining us. Coming up, is it 1999 all over again? Concerns of an encore to the dot-com bubble may be misplaced. We're going to talk about why big tech may not be the reason markets seem overheated. And Bloomberg Technology is live streaming on Twitter. You can check us out at Technology. And be sure to follow our global breaking news network, Quick Take, on Twitter. This is Bloomberg. The U.S. Justice Department has tapped an outside law firm to help in its antitrust investigations of tech giants from Google to Facebook. It is a sign the government may be preparing a lawsuit against one or more of the companies, and quickly. For all the details, we're joined now by Bloomberg's David McLaughlin. So, David, what exactly does this mean?
Right, so the Justice Department turned to a law firm that's based here in D.C., approached them about working on this investigation of the tech companies. That firm actually had a conflict, according to the people we talked with, that we spoke with, so they couldn't do it. It's not clear whether DOJ is talking to other firms, but the approach to an outside firm is pretty significant. It sort of signals that potentially DOJ is getting ready to go to court because in some past antitrust fights, most notably in Microsoft back 20 years ago, which was a huge antitrust case, of course, they went to an outside lawyer, David Boies, who was quite famous.
So is that to say this is very unusual?
It's pretty unusual. So Microsoft is one example. They did it in a merger case of about 10 years ago. That was AT&T's case against, the Justice Department's case against AT&T when AT&T tried to buy T-Mobile. But mostly in the antitrust realm, when the Justice Department or the FTC brings cases to stop mergers, they use their own law firms. So the Microsoft case was notable for when DOJ hired David Boies. But in general, they use their own lawyers. They may turn to other law firms when they need sort of additional resources, which could be the case here.
The firm they spoke to, Kellogg Hansen, according to your reporting, does that firm give us any clues about what kind of help the DOJ needs?
That's a firm that's known generally for its work on litigation matters. They're not a huge firm that might be as well known in legal circles, but it's the firm where Supreme Court Justice Neil Gorsuch once worked before he was nominated to the Supreme Court. What we don't know here is whether the Justice Department has talked to other law firms about doing this work. So I think a little more work needs to be done here to find out exactly what this means.
Now, give us the latest on the investigation. Attorney General Barr has said this investigation in particular would move very, quote unquote, quickly. Do we know how quickly? How soon could we see some actual action here?
Well, so he talked in December about getting this done sometime this year. Which would be a big lift because this is potentially a very sprawling investigation. We know that the Justice Department is looking at Google and Facebook, potentially other companies. In the Google case, based on our reporting and reporting by other news organizations, the Justice Department is sort of focused or bearing down on Google's digital advertising business, which is very complicated. We don't know as much about the Facebook investigation. So getting it done in a year, according to some lawyers, is pretty ambitious, but Barr has expressed support for not having this sort of drag out for a very long time. And then meanwhile, we have a lot of states investigating both companies. And just as I came on the air today, there was news that the Texas Attorney General reached a settlement with Google about Texas's use of these consultants that Google has opposed. So that case is also advancing.
Interesting. Lots of competing probes. You've got the DOJ, the FTC, the states. A lot for you to continue to cover and keep us apprised of. Bloomberg's David McLaughlin in Washington. Thank you so much for joining us. Still ahead, the fate of a social app sensation in a world dominated by Facebook still doesn't look so hot. We've talked about the possibility of a next Facebook for years, but despite the social network's troubles, that may be increasingly unlikely. That conversation is ahead. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. The FANG stocks, along with Microsoft, have earned their returns by outperforming high expectations in the last 5 years. But can they keep the momentum going? And if not, what does that mean for the next 5 years? Let's bring in Bloomberg Intelligence Senior Industry Analyst Jitendra Walwal, who's been taking a deep dive on this very question. Hey, Jitendra. So first of all, let's talk about the last 5 years. Obviously, big tech has been on a roll. Why?
So if you actually look at the multiples, valuation always looks high, but we think multiples don't really tell the whole story. So what we try to do is understand what was the perception of these companies 5 years ago about 2020. So interestingly, the expectation was for Amazon to deliver about $22 billion in EBITDA by 2020. The reality, they delivered are on track to deliver $50 billion instead. Same difference we're seeing across FANG and Microsoft also, so we call them FANG and Friends for ease of use over there. But what we are seeing is, why did this outperformance happen? This happened because we underestimated AWS, we underestimated the advertising division for Amazon, we underestimated what the logistics program profitability can do and things like that. So from that point of view, from that lens, what we are seeing is they have earned their outperformance in the stocks as well by outperforming on fundamental expectations.
So have we then, the proverbial we, learned our lesson, and will we continue to underestimate them or overestimate their performance over the next 5 years?
Great question. So what we have learned is basically if the reality is significantly better than perception, then the stocks hold their high valuation. So if you look at the next 5 years, what we are seeing is Amazon is 18 to 17% growth expectation for profit. I think the outperformance over there would potentially come from advertising. I think the advertising segment is not completely baked in over here. For Google, it's going to be YouTube and cloud. And surprisingly, Facebook is bottom of the list. Expectations are like 12 to 13% growth annualized for the next 5 years. And that's what basically telling us that regulations have weighed on their expectations. So what this means really is if they can surprise by diversifying into e-commerce, by diversifying away from user-generated content, more into curated content, they can have room for outperformance there. So I think diversification will be the key word to watch really for Fang and friends over here for the next 5 years.
And obviously, we're talking about 6 different companies, though we lump them all into the FANG acronym. Which of these companies do you think is the most at risk of not outperforming our expectations?
That's a good question. So near term, I think there's risk for all of them. And that's because, all the uncertainty around coronavirus impact, some global growth slowdown, it's not been captured in expectations yet. There might be some indirect impacts, so there might be some near-term risks over here. But longer term, if we look at Amazon's expectations are the highest. We think they can deliver on that 17 to 18% expectation, but outperforming them significantly as they did in the last 5 years, that's going to be challenging. I think advertising can help marginal outperformance there, but it's AWS division that sort of drove that 5-year outperformance. Going forward, they have to now compete in this market. So they'll grow at a healthy clip, but outperformance, the surprises, that reality much better than perception will have to come from advertising.
All right, our Bloomberg Intelligence senior analyst, Jitendra Rawal, some great research there. Thank you so much for that analysis. Well, countless social media startups since the dawn of Facebook have struggled with short-lived popularity. Think Path, Whisper, Vine, and most recently, HQ Trivia. The latter two were both created in part by Russ Yusupov. Both Vine and HQ Trivia shut down almost as quickly as they went viral. Though it seems we're always talking about the potential demise of Facebook, no company, it seems, can become the next Facebook. Bloomberg Tech Sarah Frier joins us now here in the studio. So Sarah, I feel like every year we're talking about what could be the next Facebook, but those questions have become increasingly rare, right? Because Facebook is not going away and doesn't seem to be going anywhere despite its own struggles. Why is that?
Facebook has become almost infrastructure in our society now. We use it to go plan events, we use it for groups. The company keeps trying to reinvent itself, but people keep going back to the original core purpose, which is just to have it be the phone book for everyone they know. Now, I think that's going to change generationally. There are a lot of apps that are catching on with younger people who don't necessarily consider Facebook to be a key part of their social lives. Maybe they have to join a Facebook group for their language class at school or their soccer team, but they don't necessarily need it for their friends. And so once that starts happening and that continually grows up, I think we might see a change in behavior, but they might move on to companies also owned by Facebook, like Instagram and WhatsApp.
So let's talk about HQ Trivia in particular, because this is a company that just announced that it is also shutting down almost quickly as it was the hot new thing. In this particular instance, what went wrong?
Well, there was a lot of managerial strife at that company, a lot of bad decisions about how to scale. And a lot of times what we've seen is that the people who are competing with Facebook, it's not just that they're competing for the consumers in the market, they're competing against Facebook's operational efficiency and their strength in the market and their ability to keep growing. And we saw that with Snapchat, remember? Like that company had a lot of organizational problems at the top and their redesign didn't go over well. And they almost shot themselves in the foot more than Facebook did, even though Facebook was constantly trying to take them down. And now they seem to have recovered from that, but not everyone does.
So if you could put your money on it, in a decade, will there or will there not be a next Facebook?
I think there will be something. There will definitely be something, because I think that our communication is getting more visual, it's getting more video based. I don't think Facebook has historically been very good at that aspect of it. We've seen TikTok catch on like wildfire in the United States. Whether or not that's going to go the way of Vine remains to be seen. But I do think that there's potential, but we just don't see who's going to do it right now.
All right, Bloomberg Sarah Frier, thank you so much. Fascinating question to always ponder. Well, two legacy tech giants continue to battle it out. HP pulling out all the stops to block Xerox's hostile takeover bid. The company has adopted a shareholder rights plan that would make an acquisition more difficult. HP says the plan would encourage Xerox or any other potential buyers to negotiate with the board. To discuss, we are joined by Bloomberg Tech's Nico Grant, who's been taking a closer look at this. So talk to us, Nico, about what this shareholder rights plan actually does here.
So this is basically a poison pill for this deal. And in every situation over the last decade in which you've seen a company try to take over another one with some hostile means, particularly a tender offer, you've seen a poison pill. And so in this situation, should a company try to buy 20% or more of HP, all of the other holders of HP would have the right to this special class of stock that would give them the same voting power and the same dividend rights as one regular common share. So basically, it expands the pool of shares, even if someone is able to accumulate 20% or even a majority.
Let's talk about the players here, because you've got HP and Xerox, and you've got Carl Icahn, who is the largest shareholder in Xerox and has been pushing this. What strings is he pulling behind the scenes?
So HP has alleged for a good amount of time in this process that they thought that the entire thing was being driven by Carl Icahn, who, as you said, is the largest shareholder and has strong ties to the rest of the Xerox board as well as Xerox management. John Visentin, who's the CEO of Xerox, used to work for Carl Icahn. Carl Icahn says that Xerox has been pushing the process. He's in favor of a deal, but he told Bloomberg yesterday that he would like to see any deal in which either Xerox buys HP or HP buys Xerox. He's agnostic on that front, so long as the management team of Xerox is the one that's in charge. He feels like the HP team is just sort of doing small things around the margins that aren't actually going to help the company in the long term.
And at this point, given the competitive landscape, why might a merger or a takeover make sense or not make sense?
So you have a situation in which people are just printing less documents than they used to. In offices, obviously, which is Xerox's bread and butter, you still have a good deal of printing. But from a consumer standpoint, where HP is stronger, you have seen a secular decline that doesn't seem to be going away. So the idea is to come together to have economies of scale that would allow a combined company to reduce costs, reduce their supply chain, of course, cut the number of employees that it has and duplicate roles. And Xerox says that there would be $2 billion of synergies. The question is if a combined company would be able to grow. I was speaking with someone the other day who said that, even if this is one combined company, you still have the same competitive dynamics taking place in the printing market because Canon, Ricoh, Epson, Brother, and a whole host of other printer companies are still out there.
All right, Bloomberg Tech's Nico Grant, I know you will keep us posted. Thank you. Coming up, move over e-commerce, enter 3D commerce, how mixed reality is shaking up shopping online and on the street. This is Bloomberg. Imagine if you could try on a pair of Nikes or an expensive necklace before buying it online. Wouldn't that be nice? Now an LA-based startup is trying to make that a reality in mixed reality. Ventana's software powers 3D shopping experiences, and the goal is to bring products to life and give buyers more certainty and less uncertainty about their purchases. Co-founder and CEO Ashley Crowder is our Retail Transformed guest. She joins us now from LA. Ashley, we've all bought a pair of shoes online and then regretted it when they arrived. How exactly could your technology change that equation?
Yeah, that's exactly the problem. And we've seen that 3D assets give customers a better understanding of the product. So actually being able to see the product in 3D and even do a virtual try-on with augmented reality has proven to not only double conversion rates, but also significantly reduce returns, saving companies time and money. The issue is, to date, it's been really expensive and time-consuming to create these types of 3D assets. So at Ventana, we built a robust content pipeline to significantly reduce the time by about 80%. So helping companies save time and money in creating and distributing these 3D assets.
Now, making it look better online is one thing. Actually being able to virtually try on a shoe is a ways off, isn't it?
It's not. It's actually here today with the advent of all the new phones coming out this past year. I'm sure most people watching watched the Apple news release last year, which talked about the multiple cameras on the phone. That's all to do better tracking, to do virtual augmented reality try-on. There's apps today. If you look at Warby Parker, you can actually virtually try on a few glasses. The issue, though, has been helping companies scale. It's one thing to do it for 1 or 5 products. It's another to do it for 25,000. And when you look at companies like Adidas and Nike, they launch 25,000 products a year. And our software really helps people do this at scale.
So Adidas, Nike, Microsoft, Lexus, Mercedes, these are your customers. Give us some specific examples of how the technology is helping them.
Yeah, so a great example is Shaw Jewelers. They're a client we work with. They have over 4,000 jewelry products. There's no way they could hire 3D artists to recreate all 4,000. They use our software to digitize their entire line and have 3D assets across web, augmented and virtual realities. Another example, we started the company providing turnkey hologram solutions with our best-in-class technology, and companies like DJI would send us an 800 megabyte CAD file of their product. It's too big to put on your website, it's too big to put on a phone, and that would traditionally take weeks of a 3D artist's time to strip down and make it usable. Our software can do that in a few minutes.
So, the goal here is to sort of straddle the online and the physical world. Let's talk about the hologram. Again, something that has, for many, many years, seemed futuristic, but as you say, maybe closer than ever, if not here in some places. Talk to us about how your technology works in this instance.
Right, so when we started the company, their phones weren't capable of AR yet, there weren't headsets on the market, so we provided turnkey hologram services, and it's hardware that projects holograms, and we were creating all the content. And so of course, brands would want to leverage their celebrity endorsement deals and show off their products. And it was really, when we got to these products, every client from Lexus to DJI to Adidas, nobody had the proper 3D assets. And that's where we really saw this area to innovate and help automate with software. And so that's what we're really excited about now that we have all these other platforms that require these 3D assets like web, AR, and VR. We're helping people create and distribute those assets at scale.
All right, fascinating stuff, especially for someone who likes to shop. Ashley Crowder of Ventana, thank you so much for joining us. Still ahead, road cleared for Tesla. The company gets the go-ahead to resume clearing a forest in Germany for its new factory. We have all the details ahead. This is Bloomberg. Tesla has gotten the go-ahead to resume clearing a forest in Germany, where it plans to build a massive factory. A Berlin court has overturned an injunction that temporarily blocked the project, averting a lengthy delay. Joining us to discuss, Bloomberg's Ed Ludlow. So obviously good news here for Tesla. Why is it so important for them to get this factory up and running and quickly?
So Tesla's ambition basically is to build vehicles where the customers are, right? And so Tesla produced 360,000 cars over the water from us in Fremont last year. But those cars, some of them were destined to go to China, some to the European Union, some to the US, some to other markets. They all have different regulatory requirements, different specs. And this is something that Elon Musk talked about on the last earnings call, that he said it's simply silly to build all the cars in Fremont and then ship them all over the world when they could be building them where the customers are. And potentially that brings cost savings, it boosts your margins, it makes them regulatory compliant in those areas. And so that is what their goal is. They have the Shanghai Gigafactory. That's their second biggest market now behind the US. But Europe's really growing. There was 70% revenue growth in China, but like 60% revenue growth in the Netherlands and in markets like Norway and Germany. So that's what they want to do. They want to streamline the production process and make it localized where the customers actually are.
And the goal is to produce, what, like 500,000 cars in this particular factory?
Right. So the aim for this year is 500,000, which seems like a big jump from 360,000
We'd expect no less
year.
from Elon Musk.
But the bigger picture is, right, that only 2% of global cars produced are electric. Or the other way of looking at it is that 98% of all the cars produced around the world still have combustion engines. So it's really hard to tell what Tesla's growth is because it already dominates a lot of the EV markets around the world. But that's their ambition for this year, 500,000. The question overhanging them is, like, how quickly can they build the German factory? Because they did the Shanghai Gigafactory in 10 months. It doesn't look like that would be as fast or as possible in Germany. And they're also, are dealing with the impact of coronavirus, just like every other automaker.
So let's talk about what's happening with the Shanghai factory, because obviously we have the coronavirus. We've seen that take a big impact on Apple. Leading up to that, U.S.-China trade tensions, which are still lingering. How successful has the China factory actually been for Tesla?
So they were just starting to produce in Shanghai when this all came about, just a few vehicles, right? And they were in the stage of ramping up. They resumed production on February the 10th. They were pretty open on the last earnings call that it would set them back by 1 to 1.5 weeks. There would be some impact on first quarter profitability. But we actually don't know what the impact is to their supply chain or actually how many vehicles they're producing. What we do know is that it's really stopped consumer in China's getting out there and visiting the sales floor for all automakers. It fell like something 92% in the first 2 weeks of February. So even if they have their production capabilities up and running in China, the question is whether there are any Chinese consumers actually out there buying Teslas, or whether Tesla's strategy of digital first, right, going to the website and ordering your car rather than going to Dia is paying off for them.
All right, Bloomberg's Ed Ludlow, thank you so much for that update. Sticking with EVs on the brink of change. Our special series premieres on Bloomberg Television tonight, 9 p.m. Eastern. The special explores the future of electric cars, the competitors, the path to mass adoption, and the challenges facing consumers and car makers alike. Here's a taste with Bloomberg's Alex Steele, who spoke with the heads of Peugeot and Ford on coming together to make it in EVs.
Electric vehicles, a car that runs on batteries. They work in lots of different ways. Here's one of them. Take a Tesla. A 300-mile battery pack is made up of 7,000 lithium-ion batteries. Inside the batteries, tiny ions of lithium move from an object called the cathode to the anode. The battery is made up of nickel, cobalt, lithium, and aluminum. This generates a flow of electrons, or electricity. These batteries pack a serious punch. They have a large charge and discharge rate, so they produce a lot of energy and you can reuse them a lot. To prevent the batteries from overheating, an EV uses a cool liquid that flows between the batteries. Then an inverter takes this power and changes it to an alternating current. Think of it as a voltage that changes. From there, it produces a rotating magnetic field in the motor, and voila, you have power. The drivetrain distributes that power to the wheels, so you can drive your car. Any electricity that isn't used, like if you slam on your brakes, is sent back to the battery pack. The $36,000 Chevy Bolt goes 238 miles on a charge, and the top-tier Tesla Model S can go 315 miles. After that, you gotta charge it, about 30 minutes at a station and almost a full day if you plug it into your home. The cool part is the battery sits low and flat on the bottom of the car. Think of it like a skateboard. This lower center of gravity helps balance your driving. So, does it all work? Well, the U.S. average cost of gasoline is $2.55 a gallon. It's $1.21 for an electric e-gallon. You save 50%. Now, prices do vary, and the more miles you go, the more expensive the car can be, and prices can range anywhere from $30,000 to $180,000. But the hype is hot, the personalities are big, cars are sleek. Is it worth it?
You can tune into that special EVs on the Brink of Change tonight, 9 p.m. Eastern Time. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. You can check us out there at Technology. Tune into our global breaking news network Quick Take on Twitter. Have a wonderful weekend, everybody. It is Friday. It's been great being back. I will see you back here on Monday. This is Bloomberg.